Bueno, pues Ucrania en este caso advirtiendo, amenazando a Rusia. Vamos a cambiar de tema, vamos a hablar de renta fija. Lo vamos a hacer con Michael Keough, que es gestor de carteras de renta fija en Janus Henderson. Michael, thank you so much for being in Negocios Televisión. Good afternoon.
Hey, good afternoon. Thanks for having me.
Michael, your company just completed some research looking at trends in corporate debt levels across the world that has reached a new record. Can you explain what you learned and whether that means companies are in a weaker position this year?
Yeah, so the purpose of this research is to look at trends in corporate debt around the world so we can try to identify the risks and opportunities as we invest. And so the study looks at how companies are financing themselves. Are they borrowing more money? What's the cost of that debt? Excuse me. But you know, the balance sheet or how much they borrow is only one side of the story for a company's credit risk. We also have to look at their earnings. Do they have too much debt or too little debt relative to their profitability? Or, for instance, are they earning more money that allows them to take their debt higher? And so what we saw in the numbers when we dug in and looked is overall net debt levels across the globe reached 7.8 trillion. This is 6% higher from the year before and back to levels that we saw in 2020 and 21 when companies borrowed a lot coming out of the pandemic. So yes, we would say that the debt is at a high level, that it increased, but it makes us ask the question, does that mean credit risks are increasing? And the other side of it that I mentioned, how about earnings and what does that look like? Their corporate profits were up over 14% last year, benefiting from the economic recovery. So that tells us companies are earning more. That allows them to support those higher debt levels without it being a big risk. And so while this, I think one other thing important to mention is while this study looked at corporate debt and what companies are borrowing, I'll also say one area that we saw much more aggressive increase in debt levels are on government global central bank balance sheets. They took on more debt to protect companies and help them navigate through that pretty well.
Michael, the report mentions that higher interest rates are a headwind to companies. Have they felt the full impact yet, or has this resulted in any investment opportunities?
I think it's important to just remember that it takes time for higher interest rates to flow through to companies. The large investment grade debt markets, only about 10 to 15% of a company's overall debt comes due in 1 year. So it's a very slow process as they refinance that they're impacted by higher rates. So last year we only saw interest expense go up by 5%, which is, I'd say, a much lower level than you may think to know that yields in fixed income went from 1 to 2% up to 5% now. So it takes time. I think it'll continue to take time to flow into for companies. That's that lagged impact of monetary tightening that we hear about. Your question on has it created opportunities? I think it has, and it has for investors. And recall, it was only back in 2020 and 21 that there was 18 trillion of negative yielding debt across the globe. That's plummeted to 1 trillion today. And we've seen yields in the investment grade market at 5%, high yield at 8%. And those are some of the highest yields available for investors since almost over 15 years. And so remember, we call the asset class fixed income because it's supposed to give you income and yield. It's really giving you that today. So while higher interest rates have been a headwind for companies, it's created really attractive opportunities for lenders and investors on the other side.
When we spoke, Michael, it was shortly after the banking sector turmoil. Have things improved in the sector? Are there any risks that you're watching that may impact the economy?
Yes, I would say I think we spoke just shortly after some of the bank failures, and we have seen some fairly positive developments. The passage of time without any more bank failures, companies and customers have stopped withdrawing their money from bank accounts. So as more time passes without having more problems, that's a good development. So that acute stress has kind of calmed down, but banks are going to have to deal with lower earnings. And as a result, they're going to lend less money to companies and consumers. So that's probably one of the bigger risks that investors have to pay attention to right now is as banks lend less because of their more conservative positioning, how does that flow through to economic growth and what is the overall drag on it in the coming quarters?
What is your outlook on inflation, and do central banks need to continue hiking interest rates?
Look, across financial markets, we had some very important data last week, and then in the US, some more in the UK this week, and we've been waiting for sticky inflation to come down. And we finally got some decent reports that show that process has really begun to happen and may be taking hold. CPI and PPI look better. Headline inflation has declined from 9% to 3% in the US. And so those are some very positive developments, and there's some things that should allow those trends to continue over the coming quarters. And so while that's positive, I think, what does it mean for, we have the Fed next week. Our expectations are that they're going to hike one more time, 25 basis points, and that they're going to communicate and reiterate their commitment to bringing inflation down. So they want to keep financial conditions and interest rates restrictive till they can see multiple months of inflation being at these lower levels. So we think it's good. They'll hike, and then they have almost 2 months before the next meeting to stop, look around, and see the incoming data, and if some of those lower inflation readings are confirmed over the next couple months. I'll add, though, I think it's important to step back and have some perspective to say, I know we talk about, is there going to be one more or two more hikes, and is that it? And I don't know that matters as much when you can just step back and say, yes, the Fed is near, and I think global central banks, some of them a little bit more behind, we're very near the end of the global rate hike cycle. We've raised over 500 basis points, so another 25 or 50 basis points is manageable in that context. And we believe that when central banks end a rate hiking cycle, that's a positive development for markets in the economy.
Stock markets and fixed income credit sectors, Michael, have seen strong results, returns recently, despite concerns around a recession. Do you think that the chances of a soft landing have increased?
I'll start by saying we think that concerns around a recession were very valid earlier this year, and you still have to be mindful of them. We had very aggressive central bank tightening. We had geopolitical shocks. Then earlier this year, we had banking failures. And so those are some of the those things historically over a lot of cycles have led to a more severe economic slowdown. And so you definitely need to pay attention to that, and it was reasonable to prepare for it. I think what we've seen so far year to date is much more economic resilience than many expected. Companies, while their earnings are slowing, they're still doing okay. Consumers remain in a very strong position. And I think it's very important to know that we've seen that inflation come down, and we've seen it without job losses going up. Companies haven't had to cut a lot of workers to get inflation to come down. And that's a very important development that was not expected. And so as seeing that definitely does increase the probability of a soft landing. But as I mentioned a minute ago, we still think there's some risks out there to watch. We talk about long and variable lags to monetary policy. On average, over many economic cycles, it takes 12, 18 plus months for that to be felt by the full effects of the economy to flow through. And we're actually just getting in that window right now. So while we've had the economic resilience, we need to just be aware that the full impact of the policy tightening will continue to slow growth some. And so we're focused on that. And in the meantime, we think it's just prudent to invest in high quality companies that can navigate just a wide range of economic outcomes, whether it's a soft landing or a hard landing or somewhere in the middle.
Michael Keough, gestor de carteras de renta fija en Janus Henderson, thank you so much. Have a good day.
Yeah, thanks for having me.